Hi, Clark F. Harvey, the barbecue mortgage guy, owner of First Rate Mortgage. Been serving clients for over 22 years in both residential and commercial real estate, licensed in 5 states. Today, I want to talk to you about mortgage insurance. I know mortgage insurance that's connotation has been drug around a lot recent the last few years, and it's kind of a bad word, and you don't want to have mortgage insurance. And there's certainly ways to avoid that. One of which is if you're buying a house and you want to put 20% down on a conventional loan, you will not have mortgage insurance. But a lot of people don't have that 20% down. So what do? Well, there's a couple of ways to avoid that on a conventional loan. One is you can put, say, as little as 3% down and not have monthly mortgage insurance. Basically, what you're doing is you're buying out the mortgage insurance by raising the interest rate up. So there's still a mortgage insurance company insuring that lender in case you default. And the cost of that mortgage insurance is based on how much you're putting down, the loan size, and your credit score. That's the factor. There's a factor that they use. So if you put 5% down, 10% down, 15% down, it's all going to be slightly different. It's going to lower as more you put down. And the higher your FICO is, your credit score is, then the lower the mortgage insurance is. But it's still a great way for someone that doesn't have the down payment to buy a house at 3% down. Well, like I said before, one way is you can buy it out, meaning you raise the rate up and you're going to buy out that mortgage insurance monthly amount. But if you want to have a lower rate and have monthly mortgage insurance, which is fine too, then you can go ahead and do it that way. So basically, and I'll explain how the mortgage insurance company works, is the lender says, hey, we're willing to lend on this client based on their criteria. However, we want a mortgage insurance to kind of insure us in case we default and there's coverage like 30% coverage, 25% coverage of loss. And so that way the lender doesn't take all the loss, the mortgage insurance company. So there's two companies involved when that happens. And it allows you to get into a home with little down. Now, on a refinance, you have the same situation based on the appraised value and the current loan amount. If you're less than 20% down, you're going to have mortgage insurance. You could also buy it out through the rate as well. But we've been able to get mortgage insurance companies to reduce their rates, but they have rates too, just like an interest rate. So it's fluctuating as well. So it depends on the time that you buy or refinance what that rate, that mortgage insurance factor is. And there are several mortgage insurance companies that we can go through. Some will insure, more coverage with less factor of a mortgage insurance per payment per month. And so that's how that's going to work. On a conventional loan, this is all on conventional loans. VA don't have monthly mortgage insurance. VA allows you to borrow up to 100% of the purchase price plus the funding fee, if there's a funding fee involved, depending on the service person's, if they have disability or what their service is and how long they've been in service, whether it's been first time use, second use, that's a funding fee. But they don't have mortgage insurance on a VA loan. Now, if you go to FHA, currently FHA has mortgage insurance on every single loan, no matter what the loan to value, how much you put down. That's FHA's current standard. And that hasn't changed for the last probably couple of years, but FHA does update those things from time to time, and that could change. But as of right now, you have mortgage insurance no matter what your credit score is, what the down payment is. And now it does lessen a little bit the more you put down. And so if you put down the minimum, like 3.5% down, if you put down 5% down, it lessens a little bit. But right now there's mortgage insurance on those deals. which is, again, not a bad thing. It's not the end of the world. It allows you to buy a house with less than perfect credit, or if you have great credit, depending on the loan program, FHA is a great less than perfect credit situation. Conventional, they're going to have a little bit more stringent criteria on credit, and so that's a great way as well. USDA loan has a mortgage insurance on there as well right now, and they have a small factor. It's not too expensive on a USDA, but that is a way to buy a house as well if you fit within the criteria of a USDA loan. But mortgage insurance, again, is a great way to get into a home without putting 20% down, because very few people are able to put that much down, especially if it's their first home. Maybe the second or third home, they can do that and use that equity. But a lot of people, it's tough to do. But it's a great way to get into home. That's what I have for you today, is the tip about mortgage insurance. It's not as bad as you may think. And I hope that helps. You guys have a fantastic day. You can always reach me on my phone number, 801-562-9100. If you have specific questions, be happy to help. And we'd love for you to like and share on our social media pages and YouTube channels. Thank you so much, and have a blessed day.
You've been listening to Clark Harvey, the Barbecue Mortgage Guy. Clark is a licensed mortgage loan originator, NMLS number 240452, and his company, First Rate Mortgage, NMLS number 1172332. You can get a hold of Clark at area code 801-562-9100 or at his website at www.thebbqmortgageguy.com.